Our 2026 second quarter market outlook highlights the impact of Middle East geopolitical tensions on global energy supply, inflation, and economic growth, with regional variations in vulnerability and policy responses. Escalation in the Middle East raises the risk of stagflation due to energy and supply chain disruptions, with inflation and growth effects dependent on conflict duration and when the Strait of Hormuz opens. Elevated oil prices may pressure households and corporate margins, influencing central bank caution amid slowing growth. The US is a net energy exporter and is better positioned to handle higher energy prices. Current economic activity is resilient, though labor market is gradually cooling. Consumer spending faces downside risks. Monetary policy is expected to remain cautious but with room to ease. Europe's net energy importer status makes it highly susceptible to energy price shocks, which could raise inflation and weaken purchasing power and corporate margins. The European Central Bank is likely to proceed with cautious policy normalization, potentially adopting a more restrictive stance if high prices persist. China's growth is robust before the energy disruptions, and China has low external energy dependency. Our view is that their 2026 growth target at 4.5% to 5%, focusing on quality-driven expansion, is achievable. Policy flexibility also allows for incremental support if required. Asian countries that are net energy importers would face challenges from sustained high oil prices, and central banks may tolerate temporary inflation increases but would likely limit accommodative measures if energy shocks persist. We prefer a selective and quality-biased approach to investment in this environment. On the macro front, US and Asia equities show relative strength from earnings trends, while Europe equities warrants caution. On a more granular basis, we are positive on South Korea and Taiwan equities that benefit from structural demand in semiconductors and technology investments. We see selective opportunities in China equities, particularly those in industries that are the focus under the country's 15th five-year plan. We remain positive on Singapore equities. The medium-term Singapore equity story continues to be underpinned by structural drivers such as safe haven fund flows, a positive industrial cycle, rising dividends per share, and liquidity tailwinds from ongoing market reforms. The Fed held rates steady, with projections for future cuts contingent on inflation progress. Bond yields have risen amid inflation fears and Middle East conflict concerns, with credit spreads widening. The US bond market is no longer expensive, and high-quality credit and Singapore bonds offer defensive opportunities supported by structural themes. To find out more, head to our website for our Market Outlook article. Thank you.